Ever wanted to invest in the future? In things like robotics, genomics, or even space exploration? Well, today, we're going to do something a little different. We're going to decode the world of these thematic innovation ETFs, but not by looking at headlines. Nope, we're going straight to the source, the official prospectus for one of the most well-known families of these funds. All right, let's jump right in. And really, this is the core question, right? The whole goal here isn't just to buy stocks. It's about trying to buy a piece of tomorrow's economy. It's this huge, exciting idea to capture growth from technologies that are really just starting to change our world. But how do you actually turn that big, exciting idea into something you can invest in? Okay, so the key phrase here, the one that everything hinges on, is disruptive innovation. This isn't about finding a company that makes a slightly better mousetrap. According to the fund's own documents, it's about identifying technologies that could completely turn entire industries upside down. Think about the shift from horse and buggy to the automobile, or from CDs to streaming music. Yeah, that's the scale of change we're talking about here. All right, here's our game plan for digging into this. First, we're going to meet the funds themselves. Then, we'll peek behind the curtain to see how they actually choose the companies to invest in. After that, we're going to brace ourselves for what is a real roller coaster ride of high risk and high reward, figure out what all that costs, and then finally, we'll ask the big question: is this the future of investing? So, you have this big idea, disruptive innovation. How do you actually package that up into an investment? Well, you create a whole family of funds, and each one targets a different slice of what's coming next. Let's do a quick meet and greet with the main players we'll be looking at. First up, you've got the flagship, ARKK. Think of this one as kind of like the greatest hits album for disruptive tech. It's the broadest fund of the bunch, and it's designed to give you a portfolio that touches on all the key innovation themes we're about to cover. Then we get super specific with ARKG, which is all about the genomics revolution. I mean, this is deep science stuff. We're talking about investing in companies that are literally rewriting the code of life, with gene sequencing and molecular medicine to fight disease. Okay, then there's ARQ. This one's all about autonomous tech and robotics. This is the fund for the future of how we make things and move things. Everything from AI-powered factories to the energy storage that's going to power the next generation of machines. And of course, looking up at the stars, we have ARKX. But this isn't just about the rockets themselves, It's the whole ecosystem of space exploration, from the orbital aerospace companies to the tech that makes it all possible, like AI and 3D printing. And finally, let's bring it back down to earth right into our wallets with ARKF. This one focuses on fintech. As the prospectus points out, this is all about the innovations changing how we use money itself, from mobile payments all the way to the core logic of blockchain technology. So yeah, those are the big players on the field. But the real question is, how do they pick their team? All right, so we've got these really cool futuristic themes, but these aren't your typical index funds that just buy a little bit of everything in a category. No, these are actively managed. So how does the fund manager decide which specific companies actually make it into the portfolio? The prospectus itself actually gives us a peek behind the curtain, and it lays out this really interesting three-step process. So here's how they do it, according to their own playbook. It starts top-down. They look at a huge theme, say genomics, and they ask, just how big could this thing get? They're sizing up the entire potential market. Then it's bottom up. That's where they get out the magnifying glass and dig into individual companies, looking at their financials, their leadership, the whole shebang. But this last step is absolutely crucial: conviction weighting. This means they don't just sprinkle a little money everywhere. They make their biggest bets on the handful of companies they believe have the absolute best shot at winning. Now, investing in unproven, world-changing technology, it sounds incredibly exciting, right? And it can be. But the word disruptive also means, well, volatile, uncertain. And the fund's own documents paint a super clear picture of just how wild the ride can get. Just take a look at this. This chart comes directly from the ARKKG prospectus, and it shows the fund's performance in 2020. That's right, a staggering return of over 180% in a single year. I mean, wow. This is the kind of explosive growth that gets headlines and pulls investors in. And this is a huge but. Fast forward just 2 years, same fund, a loss of nearly 54%. This right here, this is the whole story in a nutshell. The potential for these massive gains comes attached, hand in hand, with the risk of just gut-wrenching losses. You've seen this line before, right? It's the classic legal disclaimer you find in any fund document. But man, after seeing those last two charts, it just hits different, doesn't it? It's a really powerful reminder that this roller coaster goes down just as fast and sometimes even faster than it goes up. So, what's behind these crazy swings? Well, the prospectus is actually really upfront about it. It's a non diversified fund, which is basically a fancy way of saying, hey, we're not spreading our bets out thinly. They can make huge concentrated bets on just a few companies. Then you add in the risk that some of these cool, innovative companies might have other, less successful business lines, or that emerging tech like crypto faces a totally unpredictable regulatory future, and you've got a recipe for some really big swings. Okay, so all of this active management, this deep dive research, you know that's not going to be free. So what are we actually paying to get in on this strategy? Let's look at the fees. For most of these actively managed ETFs we've been talking about, the price tag, the expense ratio is 0.75%. What that means is for every $100 you invest, you're paying about 75 cents a year to have them manage it. And to make that number feel a little more real, the prospectus gives us this exact table as an example. It assumes you put in 10 grand and the fund grows 5% a year. After 1 year, you'd have paid about $89 in fees. But look at that. Over 10 years, that's over $1,000 in fees. It's definitely something you gotta factor into your thinking. Okay, we've looked at the big ideas, the funds themselves, how they pick stocks, the incredible highs and the really tough lows, and what it all costs. So after digging through all these official documents, it really all boils down to one big final question. And that really is the heart of it, isn't it? That's the trade-off. These funds offer you a direct shot at investing in some of the most exciting, potentially world-changing technologies out there. But as the data clearly shows, that path is anything but smooth. The fund's own documents do a fantastic job of laying out both sides of the coin, the incredible promise and the very real risk. And whether that bet on the future, is worth the volatility, well, that's a question every single investor has to answer for themselves.